What happens when consumer confidence is in the gutter, but people keep spending money like nothing's wrong? That's exactly where we are right now. And if you're in retail real estate or commercial real estate investing, this disconnect is something you need to understand. Welcome back to Retail Weekend Wrap Up. I'm Ray Kang, and every week we break down the economic and retail news that impacts your investments, your tenants, and your bottom line. So let's get into it. Let's start with the big picture and what's going on with the US consumer right now. First, the labor market is flashing some warning signs. The Challenger report came out this week and it was a gut punch. January layoff announcements surged to 108,000, the highest January total since 2009 during the financial crisis. UPS, Amazon, and healthcare were leading the cuts, and hiring, well, the lowest for any January on record. On top of that, the ADP jobs report showed only 22,000 private sector jobs added in January. That's a pretty soft number. Now, when it comes to data, there's a little frustration. We were supposed to get the official jobs report from the Bureau of Labor Statistics this past Friday, but we didn't. Another government shutdown kicked in on January 31st, and that delayed the release. This is the second shutdown in less than 6 months after a 3-day shutdown last fall that already messed up our economic data. So we're flying a little blind right now on the labor market, and that uncertainty matters. Now let's talk about consumer sentiment and consumer spending. And a lot in the headlines this week. Consumer sentiment ticked up slightly in early February. The University of Michigan index came in at 57.3, up from 56.4. Better than expected, but still historically low. People are worried about prices. They're worried about job security, and yet they keep spending. MasterCard's earnings call this week said their outlook for 2026 reflects healthy consumer spending. American Express reported retail spending up 10% and luxury retail up 15%. MasterCard CEO said that the tariff impact has been absorbed across the ecosystem and hasn't really hit consumer wallets yet. So, what do you make of a consumer who says they feel terrible about the economy but keeps swiping their credit cards? That's the disconnect. And it's the number one thing I'm watching right now because eventually sentiment and spending tend to converge. The question is, which direction? Now let's get into what's happening inside the retail industry itself. And this is where it gets pretty interesting for anyone in commercial real estate. The big headline, store openings are going up and closures are coming down. Foresight Research is projecting about 7,900 store closures in 2026. That's down 4.5% from last year and the lowest number in 3 years. On the flip side, they expect about 5,500 new store openings, up about 4.5%. The names leading the openings: Dollar General, Aldi, and Tractor Supply. And the names leading the closures are GameStop, Francesca's, and Walgreens. And this matters for strip center and retail property owners and investors. A lot of the space freed up by bankruptcies in 2024 and 2025 are now getting backfilled. Bed Bath & Beyond, Joanne, Forever 21, those boxes are being absorbed. Newer concepts with those box requirements are filling in, and other retailers are still competing for space in the same strip malls with expanding food and beverage concepts and fitness studios like SoulCycle. That's demand pressure on retail space, and that's a good thing for landlords and investors. The big story this week for store closures is Saks Global. They announced they're shutting down 57 Saks off Fifth stores and all remaining Neiman Marcus last call locations. Only 12 off Fifth stores will stay open. This comes just weeks after the company filed for Chapter 11 bankruptcy with $3.4 billion in debt. They're pivoting entirely to full price luxury. For commercial real estate, that puts a meaningful number of boxes back on the market. And depending on where those are located, that could be opportunity for repositioning or backfill with stronger tenants. On the growth side, Aldi is on a tear. They announced 180 plus new store openings in 2026 across 31 states. They're entering Maine and Colorado for the first time, adding 10 stores in Phoenix and converting 80 former Southeastern grocers locations. They're investing $9 billion in the US through 2028, including 3 new distribution centers. 1 in 3 American households shopped at Aldi last year. If you own or invest in grocery anchored retail or strip centers, Aldi is one of the strongest demand drivers in the market right now. And finally, the restaurant side. Look, it's still tough out there. Only about a third of restaurant brands posted positive comp sales last year. Consumers are trading down and traffic is soft, but there are tailwinds building. Gas prices are lower, tax refunds could put money in pockets, and the FIFA World Cup is coming to the US this summer. That's expected to be a major traffic driver, especially for full service restaurants. Meanwhile, fast growing chains like Raising Cane's, Jersey Mike's, Shake Shack, and Kava are still expanding aggressively and gobbling up retail real estate. So while the headlines may look mixed, the demand for well located retail space for restaurants and QSR is still very real. So, what does all this mean if you're in retail real estate and looking at commercial real estate investments? Here are some takeaways. Number one, the consumer is still in the game, but they're under pressure. The spending data says go, the sentiment data says caution. Layoffs are rising, but people still have jobs. This is an environment where tenants that offer value, think discount grocery, off price, quick service restaurants, they are going to outperform. And tenants that rely on discretionary full price spending could face some headwinds. Takeaway two, retail space is still tightening. Things are up, closures are down, and new construction is continuing to be limited. If you own well located strip centers or grocery anchored retail, you're in a very good position. The backfill of bankruptcy spaces from 2024 and 2025 is creating leasing velocity, and expanding concepts in food, fitness, and value retail are competing for that space. Final takeaway, watch the data. We're in a period where government shutdowns are disrupting the economic data we rely on. The jobs report was delayed. CPI data has gaps from last fall's shutdown. So fly by your own instruments right now. Talk to your tenants, watch your collections, and pay attention to foot traffic in your markets. The official data will catch up, but you don't want to be surprised. And that's your retail weekend wrap up for the week of February 2nd, 2026. If this was helpful, make sure to like, subscribe, and share it with someone in the business who needs to hear this. And I'll see you next week. Thanks.